Hey, Jeb Gerald here with Plentiful Wealth. If you watched the news yesterday, you probably saw that the Nasdaq had a pretty rough day. It was down about 3.1%, which is the biggest drop it's had since last March. So it's been quite a while since we've seen a drop of this magnitude. Today, I want to take a minute and tell you why that happened and what the long-term implications of that are going to be. So to start out, you're probably wondering, what changed yesterday? Was there some information that came out? Was there some news that came out that really precipitated this fall? And the short answer is yes, there was some new news, but it's not all bad. So what happened was the Fed came out and said they actually gave their Fed minutes, which is kind of a peek behind the curtain where they say, this is the transcript of what we talked about during our last meeting, and this is what we expect to happen on down the road. What they said was they're expecting a couple interest rate hikes over the next year, most likely 2 interest rate hikes. And so that caused the Nasdaq to sell off. You might be wondering, why do interest rates correlate with the Nasdaq or with the stock market? And that's a great question, and that's what I want to talk about today. So what happens is, when you look historically, there's a correlation between interest rates and tech stocks. And it's not necessarily intuitive at first, but I'm going to walk you through why that is what it is. And don't be intimidated that I've got some math on the board. I'm kind of a data nerd, and so I like to go through that. But it's really simple stuff and you won't have any problems. So the short answer is, when you're looking at tech stocks often don't make money right now, or at least they're not making a lot of money. They're expected to make more money in the future. And so, as you know, $1 in the future is worth less than $1 today. So why is that? It's because of this formula right here. The future value of something, anything, is 1 plus the interest rate raised to the nth power. And that'll get you the present value. So to break that down, that's like saying if interest is 2%, $1 today is the same as $1.02 a year from now. Really straightforward. It's something we all kind of grasp just because it makes sense, right? This is just how you break it down into this formula. So when you apply that to growth stocks, if you look at Apple or Amazon's a great example of this. It's made money, but it hasn't actually shown a profit for years and years. It's beginning to now. But what they've done is they've actually reinvested almost all of their earnings back into more growth. And that's why they are one of the biggest companies in the world. So if you're looking and you're trying to justify the current stock price based on future growth, this really comes into play. So we use what's called the discounted cash flow model. And that's saying that the current price of a stock is based on this year's cash flows, next year's cash flows, and then on out ad infinitum. So this is where it kind of gets interesting. When you're looking at the discounted cash flows, one of the biggest things you'll notice here is the interest rate. It's down there on the denominator. As over the last couple of years, our interest rates have been basically zero. The actual cost of capital for these companies, or for investors as well, is pretty much zero. So down on the bottom, you're not dividing by anything other than 1. But as interest rates increase, and now you have actual interest that's being paid, those cash flows start getting less and less when you start discounting them all the way back. So $1 that you're earning in 20 years is worth a lot less than $1 now because there's actually interest being paid. So yesterday, what happened was the Fed came out and said, hey, we're going to raise interest rates over the next couple of years. The bond market actually increased. It went from, over the last 5 days, it's gone from 1.5% on the 10-year to closer to 1.7, 1.75 on the 10-year. When you look at it, that's a 15 to almost 20% increase in less than a week. That's a big deal. That's flowed through to now all these companies, hedge funds, private equity, they're all looking and updating their models and saying, hey, now that this discounted cash flow has gone from basically free to 20% higher, that's impacting what we're actually able to, or what we're willing to pay for future growth. And so that's really being reflected in the stock market. You'll see that value stocks, they haven't been hit nearly as hard. In fact, some of the S&P 500 value stocks are actually up over the last couple of days, whereas the growth stocks have been hit. So for long-term investors, honestly, there's nothing that really needs to be done here. If you have a balanced portfolio, it's not really a big deal when you're looking out 15, 20 years. You're in a great position, and I'm still expecting the stock market to do well over the next few years. That's not a problem. Now, if you're looking over the next 6 months to a year, then you need to look at other options. And that's not saying that you need to sell out. That's not saying that you need to make any wholesale changes. But you need to make sure that your risk tolerance and your risk capacity matches the portfolio that you have. So don't be overweight the high volatility stocks just because you're trying to chase the growth. It might be there, it might not. You don't need to take that risk. So if you have any questions about this, if you want to chat, drop me a note, send me an email at jeb@plentifulwealth.com, or you can even set up a call at plentifulwealth.com. Thanks and have a great day.